We continue with our discussion on Unit 2 of Financial Reporting and Analysis, and now we are going to get familiar with some of the key jargons or terms that are used in the entire accounting process. Some of these data points which are very, very relevant from our understanding perspective. Some of these data points which are important for our understanding of the overall construct of how the entire process works. So we will start our discussion with understanding what is the process of this entire accounting transactions building, the entire recording process of accounts, and we will try and understand that, and then we subsequently move on to understanding some more nuances about nomenclature of accounts. How do we name a certain account, right? If we look at the recording process basically starts with something called as vouchers. So every time a company does a transaction, an entity does a transaction, you have to create a voucher, right? If I spend cash on taxi in my business, that's a voucher has to be created, which says I have debited an account and I have credited an account, right? And that has to basically work in that context. So effectively, if just a very simple example, let's say I go and buy a marker pen for the purpose of business. That's an expense, correct? Recall what happens when expenses increase, right? Marker pen is essentially stationary account, right? So it's stationary account or any consumables account that is there. So that account, when an expense happens, expenses going up is a debit, right? Remember, expenses going up is a debit, and what is going down? Cash is going down, so cash account is credit. That's the asset that gets depleted because of this, right? So effectively, I have used some of the cash to go and buy that. Now, this is a voucher that gets created at this point, which says I have debited a certain account and I have credited a certain account, right? Expense going up, debit; cash going down, credit; assets going down, credit, right? So that basically comes here. Now, this vouchers, then this collating of this data is called journalizing. You create journals out of it. This process is called journalizing. You create a journal out of all these vouchers, right? So the next stage basically creates what is called as a journal, right? Now these journals, you put together these journals and you create what is called as a trial balance. So you create a ledger here. That's a general ledger that gets created, and from that ledger, eventually from an accounting process, you create a trial balance that comes up, right? So that's what becomes the process that that comes here. So then you have from the trial balance, you'll create all the three accounting statements that come up. Now, this journalizing process is basically known as bookkeeping, right? The process of creating the general ledger essentially here is called as the accounting process. So creating from a journal, if you create a general ledger, journals are created, and from those journals you create a ledger. The ledger leads to a trial balance. We look at all these three in more detail in subsequent sections. This process of moving from a journal to a ledger and creating a trial balance is called an account. A trial balance is a straight statement which basically says what came in and what went out, right? From the trial balance, the reporting process evolves in creating of these three financial statements, which is the balance sheet, the income statement, and cash flow statement. Essentially, where does the money come in and where does the money go out, and how do you basically create those statements from the ledger and the trial balance, right? That is called reporting. So bookkeeping, accounting, and reporting, right? Now we come to a more integral and important part of the discussion, which is classification of accounts, right? There are three kinds of accounts that we will learn about. So there is a personal account. Personal account is any account that is an account of an individual or an organization, like a bank, individuals, customers, capital account, drawing account, etc. Those are what are called as personal accounts, right? We'll take examples of that. Then there are some nominal accounts. These are accounts of incomes and expenditures. So salaries, interests, commissions, etc. All these become nominal accounts, right? Finally, we have real accounts. Real accounts are those which are for real assets like, land, building, goodwill, furniture. Any assets that you have, these are called as real accounts, right? So personal accounts for individuals and organizations, nominal accounts for incomes and expenditures, and real accounts for real assets like land, building, furniture, etc. Right? So basically, every account will get classified as one of these three. Let's do a simple exercise. If you have these items where there's a trial balance that is created, and you have debits equaling credits, and at the end you're left with some cash, how do you classify these accounts? So share capital is like a personal account, right? Creditor, right? It's like a individual who's there, who has been, who's a creditor for the company. That's a personal account. Debtor, debtor is also a personal account, right? Income, income and expenditures are going to be classified as nominal accounts, correct? So income is nominal, salary is nominal, material cost is nominal, power and fuel is nominal, right? Now machinery is a fixed asset, so machinery is real, right? So that's where you will classify it as a real asset, right? Similarly, cash is a real asset. So effectively, all these accounts get classified as either personal, nominal, or real. These are just nomenclatures that we are using, the naming convention that we are using to make life easier for our entire discussion, right? So that's how we look at personal, nominal, and real accounts. Let's do a simple exercise on this, right? Very quickly. Identify which types of account do the following belong to, right? Capital, bank borrowing, stock in hand inventory, revenue from sale of clothes, machinery, commission income, creditors, electricity charges, investments in mutual funds, and repairs and maintenance, right? So where would you look at capital? Think about it. We just saw it on the previous slide that share capital is basically owner's equity. That's a personal account, right? Bank borrowing, it's a bank account, right? Now bank borrowing basically comes in, and it basically will increase your assets at some point of time, and it'll increase your liabilities. That's a real account because it's a real transaction that has happened, right? Stock in hand inventory is going to be a real account because you can see it there, right? Revenue is a nominal account, correct? Machinery is a real account. Commission income is again a nominal account, right? Creditors are personal individuals, entities, so they will be a personal account. Electricity charges are going to be nominal accounts because these are expenses, correct? Investments in mutual funds are going to be real, it's like an asset, right? So real account. Repairs and maintenance are expenses essentially, so those will be nominal accounts, right? So that's basically how you go about classifying all these individual headers into accounts. Just recall the three broad transactions: that your personal accounts are for people, entities, right, organizations, etc. Then real is all kinds of assets or basically real things that you can see and they are kind of held at a particular point. And everything to do with sales and expenses are going to get classified as nominal accounts, right? So effectively, that's how you classify all these accounts. And why are we trying to classify these in individual accounts is because the entire debit and credit entry system can also be defined as what is happening to these accounts individually. We can also, instead of looking at what we saw on the asset side, increase in assets is a debit, we can also try and understand it from the perspective of whether it's a personal account, a real account, or a nominal account, right? So debit and credit entries for a personal account is debit the receiver, credit the giver. The person who's giving the money will come in as the credit side. So that's your giver and this is your receiver. Whenever there is a personal account, you will find that whoever receives the money will be debited, whoever gives the money is credited, right? When you have a nominal account, you will debit all expenses and losses. You will credit all incomes and gains, right? So your incomes and gains will come here. Increase in income, remember, is a credit, and expenses and losses will come here. So all your expenses and losses will basically come on the, sorry, it's the other way around. It's the other way around, where we are saying that expenses and losses are on the debit side and incomes and gains are on the credit side, essentially, right? So that's with the nominal account as to what you see. Similarly, for a real account, debit whatever comes in, credit whatever goes out, right? So basically that's how you broadly put in the debit and credit system. And again, when we look at a lot more examples in terms of how we use debit and credit, the personal, nominal, and real accounts will basically go down the same line of debit and increase in assets, credit and an increase in liabilities, kind of a statement, right? So that's broadly what we are going to look at. That's broadly what we are going to kind of comprehend from the perspective of looking at personal, nominal, and real accounts. This is just another way of classifying the entire debit and credit entries. So this particular video is a shorter one. We are going to kind of work on a lot more examples in subsequent sections. We end this video with a couple of quick questions. Explain what do you mean by personal accounts, and while you're doing that, you might also want to kind of think about what do we mean by nominal and real accounts, and explain the stages in the entire accounting process. Thank you.